Understanding negative gearing. When buying an investment property, one of the many contributors that make property the best investment are the tax benefits achieved when implementing a negative gearing strategy. It shouldn't be the sole reason to invest in property, but it's something that should be taken into consideration when making an informed decision. If you're a property investor, you'll probably learn a little bit about the term negative gearing. In this podcast, we take the opportunity to provide some detail around the difference between negative gearing, cash neutral, and positive gearing. Not one particular strategy suits all, so we recommend seeking professional advice from an accountant or tax agent. What is negative gearing? Negative gearing is when your investment property generates a rental income less than your loan repayments and other ongoing costs. Ongoing costs may include council rates, insurance, owner's corporation, or water rates, just to name a few. To be in a negative geared situation, you're essentially earning less income in comparison to the overall holding cost to having an investment property. Why would investors choose this strategy? There are many underlying reasons, but effectively, an investor anticipates the capital growth to outperform the overall costs over time. This reduces their assessable income and allows them to be potentially paying less individual tax. Another way of implementing a negative geared strategy is to buy a brand new home, as it will receive a higher level of tax depreciation entitlement. Tax depreciation expenses are non-cash expenses. They are charges used to recover an asset's earlier purchase. What is cash neutral strategy? An investment properly implemented with a cash neutral strategy effectively means it generates no net cash. The rental income is offset by the loan repayments and the ongoing cost of keeping the property. Keeping a cash neutral strategy means having the rental income fully deployed to covering the holding costs. Why would investors choose this strategy? There are many underlying reasons for this too. Many investors prefer not to be paying anything regularly to keep the property, particularly if they have other personal expenses, such as family commitments. The cost of tax is minimal, as the property demonstrates a non-tax result. This can be helpful for some people wanting to reduce the worry of paying the loan and paying tax at a particular time. What is positive gearing? A property is positively geared when the rental income is more than the property expenses, including the interest on the loan. If the annualized rental income was $25,000 and the interest payments on the loan was $15,500, while the ongoing costs were $2,500, you're effectively generating a positive cash flow of $7,000 over the course of a year. Positively geared properties are when the rental return is higher than your loan repayments and the ongoing costs associated, even considering the tax depreciation entitlements too. Properties within the market that can't produce a pre-tax positive cash flow result are either positively geared by tax deductions or still negatively geared. What strategy is best? There is no such thing as which is best. The beauty of property investment is the fact that investors can alter their strategy to suit their individual circumstances. You may want to potentially start with negative gearing if your marginal tax rates are high, and later convert it to a cash neutral position if you have other costs to adhere to, or the fact you may want to buy another property. The positive cash flow can then be adopted later when you plan to eliminate the debt and look to live off the rental income at a later future date. Borrowing to invest, regardless if it's property, shares, etc., they increase the risks of investing. A geared investment strategy will receive magnified gains or losses as you're using additional funds to buy an asset. When it comes to property investment, it's very important that you borrow sensibly and ensure you're in a position to meet the cost in the event you are not receiving a rental income. Seeking advice from a mortgage broker or a financial planner will help you identify what your borrowing capacity is and learn what you can afford before committing to a strategy. It can fast-track your investment plans, but careful consideration is needed. It's also important to acknowledge that different properties, being the types or its location, will also play a large factor if you plan to adopt a particular strategy. Before investing in property, we recommend seeking professional property advice. At Crest Property Investments, we specialise in sourcing brand new and off-the-plan properties for buyers. We also do not charge any fees to buyers. If you'd like to learn more, please feel free to contact us. We welcome the opportunity to make the best property decision for you. You can go to our website at www.crestproperty.net.au. Thank you and best of luck.